Well, welcome everyone. It's great to have you here for our last event of the day, Retirement Strategies for Every Life Stage. My name is Mike Fairborn, and I'm a senior manager in trading and derivatives at Charles Schwab. I'm joined by a great guest today, Cooper Howard, who is also a CFA charter holder. He works for the Schwab Center for Financial Research and also where they develop top quality research and timely market insights for investors. So it's great to have you here, Cooper, and looking forward to it very much.
Yeah, thank you for having me, Mike. Thank you to everybody for joining in and happy National Investor Day.
Absolutely. Now, we've got some disclosures to read, but before we do that, I just want to invite everybody to subscribe to our Trader Talks channel on YouTube if you haven't already. So, on to some disclosures here. Okay, Schwab does not recommend the use of technical analysis as sole means of investment research. Now, investing in a money market fund is not insured or guaranteed by the Federal Deposit Insurance Corporation or any other government agency. Past performance is no guarantee of future results. And a quick note, Morningstar, all rights reserved. The information contained herein is proprietary to Morningstar and or its content providers. Next slide there. Oh, seem to be getting the slides here. Okay, and wanted to note too, information here is intended for general information and education purposes only. Investing does involve risk, including the loss of principal, and for some products and strategies, loss of more than your initial investment. Finally, fixed income strategies are subject to increased loss of principal during periods of rising interest rates. And with that, Cooper, let's go ahead and get started.
Yeah, thank you very much, Mike. Let's cover the meat of the situation right now. So now
Absolutely.
that we got the disclosures out of the way.
Exactly. All right. Now, Cooper, can you give us an overview of what we're going to be discussing today and why that is important?
Yeah, so we're going to be discussing retirement stages for every different life stage. And the way I kind of want to break this discussion down, Mike, is I want to start it off in three different pieces. I want to start with discussing what it's like, what is important to an investor who's maybe just beginning their investing journey. So somebody that might be on the younger side of things, then somebody who might be kind of in the middle of their investing journey and nearing retirement, and then somebody who might be in retirement. And what are some important pieces that they need to be aware of? And how ultimately do they take that portfolio, that investment that they've built up over many, many different years and turn it into a paycheck? And I think that that's a very important thing, especially in today's environment, because the fact of the matter is many of us are living longer and we're having to do it on ourselves. Just to put some facts and figures behind that, Mike, back in 1970, about 50% of all individuals were covered by some sort of a pension plan. So if you went into a room, you sat down at a table of 10 people, half of those, five people at that table had a pension plan. The other half had to do it on their own. Fast forward to where we're at today, and you sit down at that same table of 10 different people, only one person has a pension plan. The nine other individuals have to manage it by themselves on their own. Yes, there are additional resources. We'll cover some of the resources that Schwab offers, but it's really putting the onus on that individual investor, that individual, to create a paycheck in retirement. So I do think that that's important. The second piece about it is that we are living longer. Now, that's a good thing, but on the downside, the negative piece about it, even though there is a small little negative, yes, I'd say it's a good thing, is that it's causing investors and individuals to have to live off of their retirement income, their savings, for more of a period of time than it was previously. So I do think that those are a lot of important things to be aware of and why it's important to discuss what we're discussing today. But the big thing that I do think that's also important is just having a roadmap of where you're going to go. And that really starts with creating a retirement income plan. And a retirement income plan, there can be multiple different levels to it. We here at Charles Schwab, we have a system to where we have 7 different wealth management topics. Retirement income, retirement planning is one of them. Now, creating a plan itself doesn't have to cover all 7 of those topics. We do think that it can briefly touch on some of them or go a little bit more into depth on some of the other ones. And the reason why, Mike, we do think that it's very important to create a financial plan is because one, it allows individuals to feel more financially stable on average. It also relates to having a more of an emergency fund. So just in case you create a sudden one-time expense, you have that emergency fund available. And then third, and I think that this is most important and what's being displayed here on this chart, that at the bottom of the slide that you can see is that individuals and couples who have a financial plan, they feel very confident relative to those that don't in meeting their financial goals. So I do think the first step is ultimately knowing where you're going. And then from there, we can really tweak some things and identify how do we get to that destination.
Okay. So one of the bullets for the description of this presentation said that retirement planning starts with goals, not age. Can you tell us what's meant by that?
Yeah, so the thing that I do think is important is to start with knowing how much do you need to spend in retirement. And there's a lot of different ways that you can do that. And one of the ways that we do suggest is by creating a budget. So there's a lot of tools that are available to do that. I want to pull up some of the tools that are available. First is you can go through and you can actually create an actual line item budget. And Schwab has a tool available to this. If you go to the Schwab MoneyWise website, under tools and resources, you can have a monthly budget planner. It's that second one from the bottom up there. So that really gives an overall idea of how much individually you need for retirement income. Now, I think that that's a more important thing if you're very close to retirement, but say that you're a little bit further away from retirement. I think using a little bit of a rule of thumb can be really appropriate in that situation, Mike. And one of the rules of thumb that we think is appropriate is to assume that you might need about 70 or 80% of your pre-tax retirement income spending. That can be something that you can go through and you can begin to calculate. So once you create that budget, then you can begin to go through and to say, well, ultimately, how big of a portfolio do I need to reach that retirement income stream? So you can work backwards, if you will. So let's do an example of that. Let's assume that there's an individual that needs $100,000 in pre-retirement income. That's going to be 80% of that. So that's about $80,000. Now, based off of our calculations at the Schwab Center for Financial Research, we've assumed that a appropriate spending amount is about 4.8% of that. So first year spending rate is about 4.8% of that. You can flip that upside down on its head, take the inverse of it, and you say, well, for a 30-year retirement, you need a portfolio that's about 21 times that first year spending goal. So for a $100,000 pre-retirement spending goal, that would be a portfolio, Mike, of about $1.7 million for a 30-year retirement. So that's kind of how we can look at what is that nest egg that's out there that we need to try to achieve based off of what our current spending is today.
Okay, Cooper. Now that could sound a little daunting for some to reach that that goal, but what are your thoughts on that?
Yeah, I would actually say not just some, a lot of people. That is a very big, very daunting number. So I don't want to end National Investing Day on a down note and have people say, well, forget that. I'm never going to be able to reach that, because that doesn't assume other factors that come into play. So for example, Social Security. Many of us are covered by Social Security. It is a very important factor with our retirement income spending. So let's assume, Mike, that we factor in Social Security spending, and we assume that there's going to be $40,000 of Social Security income coming in. That's about what the average individual is expected to receive, or the average couple, I should say, is expected to receive. That actually drops that amount down of what the initial portfolio is needed by about half, to only $800,000. Now, no doubt that's a very big number as well, but let's assume that maybe you shorten retirement from that 30-year time horizon to a 20-year time horizon. And I'm not suggesting passing away earlier. I'm suggesting maybe you pick up a side gig or a little bit of an extra income prior to fully entering into retirement. If you do that and you delay retirement a little bit, that can reduce that number down to about $600,000. So definitely still a big number, but definitely more manageable than that original over $1 million amount that we had discussed earlier, Mike.
Right, definitely. And so now that we know how to calculate, basically a rough idea of what we're doing, what are the next steps to actually get us there?
Yeah, so there's a couple next steps of what to get there. And really, I want to look at this in terms of kind of what are the key themes, especially for an investor who's on the younger side of things. And really, the key themes when it comes to investing are time and volatility. Generally speaking, investments that tend to be a little bit more volatile, they do have recovery associated with them, but you need time on your side. So when it comes to structuring a portfolio in retirement, Mike, this is a very important piece, is that you want to have a combination of asset classes and assets that are somewhat volatile so that you can continue to grow your portfolio because retirement is a long period of time, but also those that tend to be less volatile so that you can meet your near-term spending goals. Now, like we'd mentioned earlier, we're going to break this down into discussing a individual who's starting off their investing journey, one who's more kind of in their investing journey, and then one who might be in retirement or nearing retirement. And Mike, the three important keys that I would say for an investor who's starting off their investing journey is one, start and save early. I think that that's a very important piece. The second is don't be afraid to take risk when it is appropriate, assuming that you can accept some additional amount of volatility. And then try to save as much as you can and make that an automated method.
Got it, Cooper. So those are some great points. And can we drill down a little bit more into the specific benefits maybe of starting early, as you mentioned that?
Yeah, so if you haven't been watching all of the National Investing Day presentations today, I did watch one of them earlier. I watched a few of them earlier, and I picked up on one key statement that I really loved. And what's the best day to get invested? And the best day to get invested is yesterday, which actually means that the second best day to become invested is today. And so I think that that is a very important piece, especially if you're starting off on your investing journey, is to start now. The reason being is that the sooner you start, that allows for compounding interest to build up. And compounding interest is really just a fancy term, Mike, for having your money grow and that growth growing on itself. So I want to use an example to illustrate how that looks. And let's take an investor who begins at age 25, age 35, and age 45. And as you can see, the investor who begins at age 25 saves the exact same amount, has over double than the investor who begins at age 45. So just by starting early, you're really allowing your portfolio and your money that you have begin to save to grow on itself. So I think that that's a very important factor to begin with.
Got it. Now, for that second point for the younger investor that you mentioned there about saving more, could we expand on that a little bit as well?
Yeah, so the second point about saving more is the more and more you can save, the more and more of a greater nest egg you're likely to have. And I think that that's also an important piece. And one of the things that we generally suggest to many of our young investors is try to make a habit of it. I know I speak to some of the people, some of our younger investors, and one of the strategies that I've seen some of them utilize is just creating an automatic debit from their paycheck, even if it's small, even if it's $25, $50, $100 per paycheck, and having that go into some sort of a savings account or some sort of an investing account. That itself, just the act of becoming invested and creating automatic deductions, I think is a very important piece because as you can see here, the more and more that you can save, assuming that time is on your side, the more and more, the larger and larger of a nest egg you're likely to have over time.
Got it. And sometimes we hear from investors younger and older, is it too risky to invest? Should I wait for a better opportunity down the road? Do you have any additional thoughts on that?
Yeah, that's a great question. And one we oftentimes hear from many of our individuals of kind of, well, the market's at all times highs. I'm going to wait for things to pull back a little bit. And what I would suggest is really what matters is being invested in the market. It's not necessarily timing does matter, don't get me wrong, but time in the market is more important than timing the market. Just to illustrate, let's assume like an investor, four different types of investors. The first investor had perfect timing. They bought every year at the market trough. So the lowest point within that year, they went ahead and they bought at that point. That's the investor all the way on the left-hand side. And you can see that over a 20-year period, they would have accumulated a little over $163,000. Let's then assume an investor who just started off calendar day one, and begin to invest there. They'd have a little bit less, $152,000. But what's notable is that's only 6 or 7% lower. So it's not that big of a deal, not that big of a loss compared to, say, the investor who had bad timing, or even worse, the investor that just decided to sit in cash. So I think one, just getting invested, getting early invested, and staying invested are very important pieces.
Got it. Yeah, and sometimes we hear from some investors about, the third point you brought up too, on taking risk. And when time is on your side and being more aggressive. Now, what did specifically you mean by that, Cooper?
Yeah, that's also definitely a great question because oftentimes some of our younger investors will hear, well, I'm going to put that into a money market fund, a cash fund. I'm going to buy a short-term CD, and that's really going to be my retirement income or my retirement savings plan. And that can be appropriate. Don't get me wrong. Having some conservative investments in a portfolio is generally appropriate. But we do think that when time is on your side, it makes sense to try to invest a little bit more aggressively because every additional percent that you can earn definitely does add up over time. It goes back to that idea, Mike, of the compounding interest. And what I'd like to highlight here is let's assume an investor invested and just earned a 1% return. You got to squint closely here on this one. Maybe if you're watching this on a phone, it's very, very difficult to see. But you can see all the way on the bottom of this chart, that investor who earned just a 1% return over time, that light blue, really didn't make that much additional money on their initial investment. Yes, they did, but not as much, say, as the investor who earned, say, 7% on their investment. So you can see that that added extra 1% over time, each incremental amount really adds up over time.
It really does. Yeah, and looking at that longer term time horizon specifically, which investments would investor maybe choose?
That's definitely an appropriate question. And I think that this also gets to the idea of how do you structure a portfolio in retirement? Because this is also a very important piece to it. But generally speaking, what we've found, Mike, and this may not come as a surprise to some, is that those investments that tend to be more volatile, they also have higher than average annual returns. And that's what we're displaying here. So you can see all the way on the left-hand side is a cash type investment. It tends to be that cash has limited upside, but also limited downside. That means that the average annual return of about 4.6% going all the way back to 1980, a little bit lower than most other types of investments because it usually has less volatility. So for an investor who doesn't have that much time on their hands, we do think that having more of a cash allocation, assuming that it's appropriate, can be beneficial. And we'll get into how do you structure a portfolio for somebody in retirement in a little bit. So we're not suggesting all cash. Obviously, that's not appropriate, generally speaking.
Sure, sure.
But you can also see that further out, those types of investments that tend to be a little bit more volatile, right here, we've highlighted international equity all the way in yellow on the right-hand side of the chart, has higher highs, but also lower lows. But that average, that median, tends to be higher than those more conservative investments. So if you do have time on your hands and you can weather the ups and the downs, both financially and emotionally, we do think being more aggressive early on in your investing career, in your investing lifestyle makes sense.
Great, great. So how would bonds fit into this? We kind of saw how the lower volatility that you pointed out, and also equates to lower potential returns than other investments. And with that being said, should younger investors with time on their side also invest in bonds?
Yeah, so we generally do think that a small allocation to fixed income can be appropriate if you are an investor who has a longer time on your a longer time horizon. And there's a couple things that bonds offer that most other investments don't offer. The first is price stability. Generally speaking, a bond is a loan between you and that issuer. And so because it is a loan and it's not necessarily kind of an outlook on earnings or an outlook on growth, say like equities are, tends to be less volatile. So that also brings me to my next point is capital preservation. So if you know that you have a near-term goal, and oftentimes retirement is a goal in the future, that capital preservation can be a very important piece. And then the third piece of it is an income piece. And this can be very important, especially for those investors who are in retirement to generate income off of their portfolio. Now, you don't have to necessarily choose just one or the other. Investing in fixed income can be a combination of all of them. Also, one of the generally reasons why we think that fixed income can be appropriate for most investors is that it tends to be that negative returns, losses aren't that common. You can see that displayed here. So we're going back all the way to 1976 using an index of the average fixed income investment. So that's some treasuries, some mortgage-backed securities, some corporate bonds, and we're looking how did those perform year to year. And what I really want you to focus in on as a listener is notice how many blue bars there are relative to how many red bars. Now, losses can occur, that is true, but generally speaking, there's definitely more blue bars than there are red bars. So that's important because as you combine fixed income to your portfolio, depending on how much you combine within your portfolio, it really lowers the volatility overall. So what we've done here is we've looked at a sample going back all the way to that 1976 period up to the end of 2025 and said, if you were 100% stocks, on average, how would your portfolio perform? Now, the best time it would have performed about a 38% total return. The worst would have been about a negative 37% total return. But on average, you would have earned about 12% year over year. That's beneficial if you have a long time horizon. If you don't necessarily have a longer time horizon, as you can see on the right-hand side, adding more and more fixed income to your portfolio, it reduces the highest returns, but also it makes the lowest returns much better. Because if you're an investor who is in retirement, experiencing those significant negative losses can be detrimental to creating a portfolio, to creating a retirement income stream. So I think that that's another very important piece about understanding how to include fixed income in your portfolio and when to include it in your portfolio.
Yeah, interesting. It cuts the loss portion almost in half there, if not a little bit more. Fascinating. So we've covered what's important to start early. It's important to start early to save as much as possible and to take appropriate risks. But how might taxes factor into all this?
Yeah, so there are two guarantees in life. One of them is having to pay taxes. So unfortunately, that is a very important piece. And I do think that looking at taxes really pays an important side to it. And this goes to an account selection piece to it. So generally speaking, the Schwab Center for Financial Research, when it comes to what types of accounts should you be invested in, it goes to tax diversification. And I want to dig into this a little bit more. So there's mainly a couple different types of accounts that you could invest in. So first off would be like a brokerage account, and that's a fully taxable account, Mike. That's where all of the dividends and interests that you receive are subject to either income taxes, capital or ordinary income taxes, or ordinary dividend taxes, plus capital gains taxes if you have to sell it. Then comes something like a tax sheltered account. That might be like a 401k or a traditional IRA. Money that's earned in that account, you don't pay income taxes on it, but when you withdraw it, you do pay taxes on it. And then there's another type of account that's like a Roth IRA. Now, the money within that account you don't pay taxes on it. And when you withdraw it, you also don't have to pay taxes on it. Granted, you do have to pay taxes. You contribute after tax dollars to it. So it also factors into what types of accounts you're looking into and how you fund those accounts. But that matters because looking ahead to retirement, the goal of retirement is to use your portfolio to create an income stream. And to do that, you're eventually going to have to take money out of those accounts. So we do suggest a combination of taxable plus tax deferred accounts. And one of the reasons why is that by looking at a tax deferred account, because you're not having to pay taxes on the investment income and the capital gains that you regularly receive, that allows that money continually to continue to grow more and more and more. So what we've looked at here is just over a 20-year investment horizon. Let's assume an investor invested $50,000. And at the end of that $50,000 20-year investment horizon, Mike, they would have had a 23% higher ending wealth using a tax deferred account. So we do think that that's also another piece of the puzzle associated with it. And it's not just earning more to reach that retirement goal because you are deferring taxes. It's also once you are in retirement, then having that flexibility to draw money from multiple different accounts and understand how do you create the most tax efficient way to create a retirement income stream.
Great insights, Cooper. And so switching to an investor, let's say, who is early in their investing journey, so there is some time before retirement, but maybe what might that's kind of a large group of people. What should they be aware of?
Yeah, so there's definitely a couple things that they should be aware of. The first is that staying invested really matters. And this also applies to someone who's a younger investment or younger investor, but also it highlighted also applies to somebody who is on the retirement stage and is investing in retirement. And what I'd highlight here is it's not just, again, timing the market, it's time in the market. So we at the Schwab Center for Financial Research did a study to where we looked back from 2006 all the way to 2025. If you were invested in the S&P 500 for every day, and the S&P 500 is a common proxy of large cap stocks. If you were invested in that for every single day, on average, you'd earn about 11%. Now, let's assume that there was a day that you said, it's not that good of a day. I'm a little worried about where the economy is going. Earnings are coming up. I'm going to get out of the market. And I'm going to get out of the market for the top 10 days. You can see here that the average return over that period, it went down from 11% all the way to 6.6%. So just, Mike, by missing those top 10 days, you nearly cut off half of your overall total return. So returns happen in very short periods of time. I think that that's a very important piece. So what is important for an investor who is in their retirement journey and trying to save to reach that retirement nest egg is having a longer term vision and not overreacting to many short-term market moves. You can see here what we've done is we've plotted out a longer term time horizon and also highlighted many significant market moving events during that time period. Directionally, notice that from the left-hand side to the right-hand side, whether it was the 87 crash, the global financial crisis, COVID, the 2008 credit crunch, over time, the market has continued to rise. Yes, there have been periods to where it has experienced negative returns, and that's likely to happen going forward. We probably will pull back at some point eventually, but over time, our belief is that equities tend to increase in value. And I think that that's a very important piece to say, I'm not going to try to time the market, but I am going to continue to stay invested in the market. And Mike, you may hear this often on the trading side. I know on the investing side, I also hear it often. One of the things that I'll often hear from clients is now a good time to go to cash? And that's not an appropriate way to think about investing because one, you're betting on a time in place in the market, but also you're having to bet on a time of when exactly to get back into the market. So yes, making asset allocation moves can be appropriate over time, but we would never suggest an investor get out of the market or get into the market because over time, what we found is that equities tend to perform well, even if there are short-term fluctuations. Digging even into the numbers a little bit more. So not just necessarily saying, okay, well, here's how it looked over a long time horizon. What I want to do is I want to look at periods to where the equity market has pulled back 5%. So this is a little bit busy of a chart, and I want to spend a little bit of a time on it, or a little bit busy of a table, I should say, and I want to spend some time on it. So the first column is when the market has pulled back an average of 5% or more, what was the return over the next month? And you can see that the average return was about 0.24%. So slightly positive, but pretty flat, if you were to say. And about 50% of the time, 52.94% of the time, it was positive. 47% of the time, it was negative. So after the market pulled back about 5%, returns were roughly flat. Half the time it was up, half the time it was down. Fast forward to extending our time period a little bit more. So 4 months, that's that next column over. You can see that the average return was about 4.4%. And about 63% of the time, it was positive. Fast forward even more, so extend our time horizon to 12 months after the market pulled back 5%. You can see that the average return was about 10.4%, and about three quarter or about 2/3 of the time, the market was positive. So again, Mike, the point of all of this is to say timing, yes, it can matter, but time in the market is more important than timing in the market. For most of our investors who have a longer period of time, we do suggest that they continue to stay invested in the market.
Interesting, Cooper. Yeah, and you've shown us with a lot of these charts too, the extent that volatility plays on gains and potential losses as well on both sides. But over these periods, when there are periods of that heightened volatility or large losses, what is it that you suggest investors to do on those times specifically?
Yeah, so on those times specifically, we do think that rebalancing is an appropriate move. And rebalancing really adds discipline to your portfolio, and it can help keep you on track and keep your portfolio in line with your investment horizon, plus also keep your portfolio in check with your risk tolerance and your risk capacity. So just to give an example of that, let's assume there's an investor in 2008, 2009, and they had a 60/40 portfolio. That's all the way on the left-hand side. And let's assume that they never rebalanced, Mike. So over time, that stock allocation, those light blue bars increased, increased, increased to the point where right before COVID, they actually had a portfolio that more looked like an 80/20 portfolio, 80% equities, 20% fixed income. And that was very important because we all know that during COVID, the equity markets fell quite precipitously. Yes, they did bounce back, but for an investor who might have thought that they were in a 60/40 portfolio and not taking on additional risk, they were actually more likely in an 80/20 portfolio because they did not annually rebalance. So we think that's another very important piece to be aware of for an investor who's on their investing journey.
Okay. So on the savings side, is there anything that investors should be, thinking about in terms of, being aware of in terms of saving for retirement as well? Any additional points there?
I think the big important points when it comes to saving for retirement is one, try to make it as automatic as possible. There are many tools and resources available to do that. Try to save as much as you can appropriately. Three, do diversify via taxes and have tax diversification because over time, saving on taxes can really help and can really build things up. And then understand that you should take risks where appropriate given your financial situation.
Got it. Okay. And so for an investor who's nearing or in retirement, that group, and just using an analogy of a flight path, we've landed on the plan, we're getting going there. So what would be next after that, Cooper?
Yeah, I like how you mentioned it as far as an analogy to a flight. So if we think of our retirement income journey or our retirement journey of traveling cross country, say from San Francisco to New York, when you initially take off from San Francisco, you really just want to be pointed in the right direction. You can make a few tweaks here or there, but if you're pointed in the right direction, it's likely that you're going to hit the East Coast at some point. And over time, as you travel, you kind of tweak the direction of the plane if you're the pilot. But when you get closer to New York, if you will, in our example, that's when things get more important and you really want to kind of dial things in, if you will. So that's an important piece because if you're an investor who is in retirement, it's not just like you're landing the plane once we hit New York. There's still a long-term journey associated with retirement. So you need to structure your portfolio so that one, it can meet near-term liquidity needs, but also continue to grow because retirement is, for some of us, a 30-year or more endeavor. So I think that that's a very important piece. And the other piece about it is looking at retirement, it poses a few unique risks, if you will. So the first is sequence of returns risk, Mike. And this is really just the risk, the chart in the upper left-hand side of saying, if I were to experience in my portfolio a negative return, it does much more damage to your overall portfolio early on than it does that later on in retirement. So what we've assumed is an investor who loses a large amount of money in year 10 relative to year 1. And as you can see, that dark blue line hits zero much quicker than that light blue line. And the point is, it kind of works as dollar cost averaging backwards, if you will. So if you experience a loss early on in retirement and you sell some of your investments to create a retirement income paycheck, that just creates less dollars to do the heavy lifting and to get back to where you were previously. So that's an important piece, an important risk of retirement that you want to be aware of that may not be applicable to saving to retirement. The second is longevity risk, and that's just the risk of outliving your assets. Now, don't get me wrong, having the longer than expected life expectancy is a good thing, but that does put more pressure onto your portfolio as well. Another risk of retirement income is inflation risk. And that's just the risk that over time, your spending is going to increase. You need to build a portfolio that's going to continue to increase with inflation so that it can help hedge against that and protect against it. And then the fourth and final risk that I'd highlight is just the unexpected expenses risk. So we might have gone through and created a budget and said, this is how much I expect to spend in retirement, but periodically something comes up. Maybe the water heater breaks. Maybe you need a new car. Some unexpected expense comes up. So we do think that having awareness of all four of these risks in retirement really is appropriate and should drive how you structure your portfolio.
Great. Now, you've given us a ton of different examples and considerations for risk specifically, but are there any specific like strategies that could be used to help combat against that risk?
Yeah, there's a couple strategies of how to combat against that risk. And the way I like to think about this, Mike, is that the different types of investments that we can choose as investors are like tools on a tool belt. So you necessarily wouldn't decide to say, I'm going to get a hammer so that I can screw in a screw. You need different tools so that you can accomplish the job. And that's true to retirement income as well. So what we generally suggest when it comes to building out a portfolio that protects against all four of those things, longevity risk, inflation risk, sequence of returns risk, and unexpected costs, is to have a bank account and some cash investments, also an investment portfolio. And then the third piece that's very important is some form of guarantee in our view. Now, I want to start left to right and focus in on the bank account and the cash investments. Generally speaking, we suggest that investors who are in retirement maintain 1 year of spending after accounting for predictable income sources in cash. Within this is something that they can regularly tap into, and they know this money is going to come from without having to liquidate assets if there is a market downturn. That can help protect against sequence of returns risk. Different types of options for that would be like a bank sweep, a money market fund, or very short-term CDs that are high in credit quality and more unlikely to default than others. Next comes your investment portfolio. This is also a very important piece, and I think what many investors really focus on. And within the investment portfolio, Mike, what we suggest is creating a short-term liquidity reserve. That can be about the next 2 to 3 years worth of spending needs. So the benefit there is that if you maintain that 1 year of cash plus the next 2 to 3 years of spending needs after accounting for predictable income sources, you know where the next 2 to 3 years of your spending are going to come from. So you don't have to be too concerned again about a significant market downturn, and you can structure your portfolio that way. From there, it begins to build out the rest of your portfolio for that growth aspect of it. So, like I'd mentioned earlier, Mike, retirement for many individuals can be a 30-year plus horizon. So, you do continually need to have your portfolio grow and grow and grow so it can meet those needs later on in your investment life cycle. And then the third piece that I would suggest is looking at some form of guaranteed income. For many of us, this might just be Social Security. And the benefit of something like Social Security is that it's indexed to inflation, so it continues to grow. So that helps protect against some inflation risk. Also, most forms of guaranteed income, especially Social Security, therefore our lifespan. So you're not going to outlive Social Security. So that creates a baseline layer of spending for your retirement income portfolio. So I think having that bank account plus an appropriately structured investment portfolio, plus then some sort of guaranteed income can help protect against four of those major risks that we identified.
Perfect, Cooper. Now, some really great insights there across just different ages, investments, investment amounts, and risks. So great insights there. We did also receive some specific questions that we've received from our clients, and so we'll have time to get into those. Before we do that, just a quick note too, if you haven't subscribed already to our Trader Talks channel on YouTube, encourage you to do that. So let's dive into some questions though, Cooper, as we get started here.
Yeah, I'm happy to.
All right, on our submitted questions. So first off, how do you figure out how much you can withdraw in retirement?
Yeah, that's a very difficult question. It really depends on your overall situation. So what I would suggest is we do have a Schwab article about retirement income spending. And it specifically relates to the 4% rule and how much can you spend in retirement. Now, the 4% rule is a commonly cited rule, and it says that in the first year of retirement, you can spend 4% of your overall portfolio, and that's likely going to have a high probability that you won't outlive your income over a 30-year time horizon. What we found, though, Mike, is that because it is a backward-looking study and it is a very conservative study, you can actually spend a little bit more of your portfolio than that 4.4% rule suggests. The other piece about it that I would highlight is that it assumes a 30-year investment horizon. So I do think that it's also important to highlight that if you have a different investment horizon than that 30 years, that 4% rule is not going to be applicable to your situation. So the best way to figure out how much you can spend in retirement is to run a financial plan that stress tests your portfolio. But if you need just a back of the envelope suggestion or calculation, then looking at this article and understanding what is my situation and how does that relate to a spending amount, I think that that's a good starting point for many investors.
Okay, great. A quick note too, just as a reminder, there was a survey link that was posted in the chat. There it is right there. So if you are able to fill that out, that would be fantastic. It's posted right there for you. Okay. Now, next question. How do you figure out how much you can withdraw, actually on retirement, specifically? If let's say a person's retired and they just need to earn 5% on their money, what is the best and safest option to achieve that? Kind of emphasis on safest, I believe.
Yeah, I love that question because we'll oftentimes get it quite a bit. I just need 5%. Where can I get 5%? Where can I get 4%? Where can I get a set percent for my portfolio? That's all that I likely need to get. And what I think is associated with it behind that, kind of one of the things that many of those investors who are asking that question forget, that might be good for now, but how does that apply 5, 10, 20, 30 years down the road? So we do think that there's a few different ways to structure a portfolio for retirement income needs. The first is looking at a dividend and interest strategy, and that's utilizing dividend and interest first and looking at that as a primary source of retirement income. The second piece that we also think is very important, and we generally suggest for most of our investors, is a total return approach. And that's not just relying on dividend interest alone, because just relying on dividend and interest alone, Mike, that can really limit you as an investor to saying, I'm only focused on what is the highest yield given the safest investment that I can get. More appropriately is likely saying, I'm going to use some dividends and interest, but also I'm going to use capital gains and that growth in my portfolio. So as I regularly rebalance, I'm going to take some of that regularly rebalanced money, put it into my 1 year worth of liquidity, and tap into that going forward. Now, I'm not saying that it's inappropriate to use dividend and interest, but we do generally suggest using all forms of your investment portfolio. And a piece to that is that the safest investments, and safest, if you will, put that in air quotes, is likely something that doesn't have an inflation hedge against it and doesn't increase with inflation. So maybe you could get 5% today, but over time, that's going to have to continue to grow. And if you look at something like a fixed income investment, that's not going to continue to grow with inflation, assuming that it's a general fixed income investment and not something like a treasury inflation protected security. So that might raise some questions of, well, I'm just going to buy stocks. I'll just find a stock that pays me a 5% dividend. The risk there is one, that dividend gets cut, or two, that stock decreases in value. So those are also another appropriate risk to it. Now, we did have a previous session about how to go through and pick out stocks for retirement income. I think that that was a very appropriate session. So again, we're not suggesting against it, but we do think utilizing your whole portfolio in a holistic manner makes more sense than trying to just focus on where can I get the highest yield given the least amount of risk.
Sounds great. Thanks so much, Cooper. Well, everyone, that does it for our discussion here. Our time is up, but thank you so much, Cooper, for your points there today. That was terrific, very informative. And thanks to all of you for joining us here today at Schwab for National Investing Day. We want you to also be sure to subscribe to the Trader Talks channel on YouTube, and everybody have a great rest of the day.